Welcome back to Insight Sphere, your go-to source for the latest crypto trends, market insights, and expert analysis. Today, we're diving deep into Bitcoin's latest price action. The king of crypto recently surged to $88,000, but despite the excitement, it has struggled to break higher. What does this mean for traders? Is this a temporary pause before another leg up, or are we on the verge of a correction? We'll explore the data behind this move, including whale activity, on-chain signals, and technical levels to watch. Let's break it down. Bitcoin reached an intraday high of $88,752 on March 24th, but since then, it hasn't set a new peak. This could be an early sign of buyer exhaustion or simply a short-term consolidation before another attempt at higher levels. Currently, the price is moving within an ascending channel, facing strong resistance near the upper boundary and key exponential moving averages, the 50-day and 100-day EMAs. The big question now is, can Bitcoin break above $90,000 and continue its rally toward $100,000, or will it face rejection and see a pullback? One of the most important indicators to watch is whale activity, the big money investors who often dictate the market's direction. According to crypto analytics platform Alfractal, whales have started to short Bitcoin at $88,000, signaling a bearish sentiment among major holders. But why does this matter? The whale position sentiment metric, which tracks open interest and trades over $1 million across multiple exchanges, has turned negative. Historically, when whales close long positions and open shorts, it often precedes a price correction. Could this be a warning sign? Let's dig deeper. Adding to this concern, CryptoQuant reports that 8 out of 10 key on-chain signals are flashing bearish. These indicators, which track factors like exchange reserves, miner activity, and whale accumulation, suggest a potential downturn. However, there are two exceptions: stablecoin liquidity and technical indicators, which still support upward momentum. CryptoQuant's CEO Kai-Young Ju recently warned that we might be entering a prolonged bearish or sideways market that could last 6 to 12 months. If that's the case, traders should be prepared for longer consolidation rather than a straight rally to $100,000. But not everyone is bearish. On the flip side, Into the Block data shows that Bitcoin outflows from exchanges have been increasing. Over the past 24 hours, $220 million worth of BTC left exchanges, bringing the total outflows to $424 million between March 18th and March 24th. This suggests that while some traders are taking profits, others are accumulating Bitcoin, potentially preparing for a long-term bullish move. This could be a sign that major players are positioning themselves for future gains, despite short-term bearish signals. So what's next for Bitcoin? Let's break it down in technical terms. Considering resistance levels $88,000 to $90,000 is the key area where whales are shorting. $92,000 is a breakout point above this could confirm a move toward $100,000. If we look into the support levels, $85,000 is the point. If break below, this could signal a deeper correction. $80,000 is a crucial psychological and technical support zone. For Bitcoin to maintain its uptrend, it must close above $90,000. If it fails, we could see a pullback to $85,000 or even lower. So, where do we go from here? Will Bitcoin break through $90,000 and continue its path to $100,000? Or are we facing a short-term correction? The market remains at a crossroads, with whales shorting, on-chain signals flashing red, but accumulation still ongoing. As always, this is not financial advice, just market insights to help you stay informed. Before making any trading decisions, do your own research and consider both risks and opportunities. What do you think? Will Bitcoin break past $90,000 soon, or are we in for a correction? Drop your thoughts in the comments below. And don't forget to subscribe to Insight Sphere for more in-depth crypto analysis. Until next time, happy trading.